Could the Japanese yen trigger the next global market sell-off? The warning hidden in plain sight. Welcome back, everyone. I'm Nicholas Gurneman. Every single day, millions of investors wake up, pour themselves a cup of coffee, open their trading apps, and immediately look at one thing: the stock market, the S&P 500, the Nasdaq, maybe Bitcoin. If they're feeling particularly adventurous, they might even glance at oil prices before deciding whether today's the day civilization finally collapses. But almost nobody starts the morning by asking a much more interesting question: what's the Japanese yen doing today? And that's exactly why it's worth paying attention. Financial history has a funny habit of rewarding people who look where everyone else isn't looking. Markets rarely send engraved invitations announcing the next wave of volatility. There's no push notification from Wall Street saying, "Attention investors, turbulence scheduled for next Tuesday at 9:37 a.m." If only it were that easy. Instead, markets whisper. They leave clues, tiny shifts that seem insignificant until they're suddenly impossible to ignore. Sometimes those clues come from bond yields, sometimes from credit spreads, sometimes from commodity prices, and every so often they come from currencies. Now, before your eyes glaze over because the word currency sounds about as exciting as reading your internet service agreement, stay with me. Currencies are not some obscure corner of finance reserved for economists wearing bow ties and speaking in acronyms. They're the plumbing of the entire global economy. And if the plumbing starts making strange noises, it usually isn't because everything is working perfectly. Imagine trying to build a skyscraper while the foundation slowly shifts beneath it. At first, nobody notices. Workers continue doing their jobs. People admire the view. The elevators still work. But eventually, the stress begins showing up somewhere else. Small cracks, uneven floors, doors that suddenly won't close properly. Financial markets behave much the same way. The biggest problems rarely begin where everyone is looking. They begin underneath. Currencies are part of that foundation. They're constantly adjusting to changes in growth, inflation, interest rates, government finances, investor confidence, and expectations about the future. By the time those changes become obvious in stock prices, the currency market has often been processing that information for weeks or even months. That's why professional investors spend so much time watching markets that most retail investors barely know exist. Not because they're trying to sound sophisticated, because they understand that information usually travels through financial markets in a sequence. Currencies react, bond markets react, credit markets react, stocks eventually catch up. Of course, markets don't always follow that order. If they did, everyone would be rich. But the pattern appears often enough that it's worth paying attention whenever unusual currency movements begin attracting attention. Now let's clear up one common misconception. People often hear the phrase foreign exchange market and imagine tourists swapping dollars for euros at an airport kiosk. That couldn't be further from reality. The foreign exchange market, often called Forex, is the largest financial market on Earth. Not the biggest stock market, not the biggest bond market, the biggest market. Every weekday, trillions of dollars change hands. Governments participate, commercial banks participate, hedge funds participate, corporations participate, pension funds participate, central banks participate. Even companies you've never heard of are constantly buying and selling currencies simply to conduct international business. In other words, the currency market isn't reacting to headlines. It's reacting to global economic reality in real time. And that's precisely why movements there deserve attention. Now let's talk about today's main character, the Japanese yen. Poor yen. For years, it's been treated like that reliable friend everyone calls only when they need help moving furniture. Nobody talks about it at dinner parties. Nobody brags about owning it. Nobody posts screenshots on social media saying, "Guess who's long the yen today?" It's not glamorous. It doesn't generate headlines like artificial intelligence or cryptocurrency. But beneath that quiet reputation lies one of the most influential currencies in modern finance. Japan occupies a unique position in the global economy. It's one of the world's largest economies. It possesses enormous pools of domestic savings. Its financial institutions manage extraordinary amounts of capital. And perhaps most importantly, Japan spent decades living in an economic environment unlike almost every other developed nation. While other countries periodically worried about inflation, Japan spent years wondering whether prices would ever rise at all. That unusual situation pushed Japanese policymakers toward policies that once seemed extraordinary. Ultra-low interest rates, massive bond purchases, extremely accommodative monetary policy. Those decisions shaped not only Japan's economy, but global finance itself. Because whenever money becomes exceptionally cheap in one country, investors naturally start asking a simple question. Can I borrow here and invest somewhere else? The answer was yes, for years. Borrow cheaply in yen, convert the money into another currency, purchase assets offering higher returns, collect the difference. Simple in theory, complicated in practice, potentially profitable until it isn't. It's one of those strategies that looks brilliant right up until everyone heads for the exit simultaneously. Think of it like leaving a football stadium after the game. One person walking through the tunnel? Easy. 70,000 people deciding to leave at exactly the same moment? Good luck. Markets experience similar moments. As long as confidence remains high, liquidity appears abundant. Everyone assumes there's always another buyer. Then confidence changes. Suddenly, every investor wants to reduce risk at once. And that's when markets discover the difference between liquidity that exists on paper and liquidity that actually exists. This is one reason currency movements can matter far beyond exchange rates themselves. They're often connected to the availability of global capital. Now, let's inject a healthy dose of realism. None of this means every move in the yen predicts disaster. Financial television has enough apocalypse merchants already. According to them, civilization collapses every Tuesday before lunch. Then Wednesday arrives and somehow Starbucks is still open. Markets are complex. No single indicator explains everything. Anyone claiming they've discovered one chart that predicts every correction should probably also be selling miracle vitamins on late-night television. Good investing requires probabilities, not prophecies. The goal isn't to predict the future with absolute certainty. It's to recognize when the balance of risks begins shifting. That's a far more useful mindset than trying to forecast the exact day or hour markets might move, and lately, several of those risks have started converging. Interest rate expectations, government borrowing, central bank policy, currency volatility, global capital flows, each tells part of the story. Together, they paint a much more interesting picture. Because beneath all the daily headlines about earnings, inflation reports, and political drama lies a quieter force that may be becoming one of the defining economic issues of this decade. Debt. Not just America's debt, not just Japan's debt, global debt. And as we'll discover next, the size of a country's debt burden may increasingly determine which currencies rise, which currencies fall, and why investors around the world are beginning to rethink assumptions that seemed unquestionable only a few years ago. Before we dive into that, if you've made it this far, congratulations. You officially know more about the Japanese yen than the average financial commentator who only remembers it exists when markets panic. If you enjoy thoughtful macroeconomic analysis with a healthy dose of humor, hit that subscribe button and join the Nicholas Gurneman community. Because unlike inflation, our goal is for your financial knowledge to keep appreciating. Next, we'll uncover why debt, not headlines, may be the hidden force quietly reshaping the global currency market. Could the Japanese yen trigger the next global market sell-off? What if one of the biggest warnings for the next stock market correction isn't coming from Wall Street? What if it's coming from a currency pair that most investors rarely pay attention to? While headlines continue to focus on inflation, artificial intelligence, corporate earnings, and interest rates, another market has quietly been sending signals that have historically preceded periods of heightened volatility. That market is foreign exchange. More specifically, the relationship between the US dollar and the Japanese yen. At first glance, the movement of one currency against another may not seem like something capable of influencing trillions of dollars in global assets. But history suggests otherwise. Currency markets are often the first place where investors react to changes in economic expectations, central bank policy, and government debt. Sometimes those reactions stay contained. Other times they spread across stocks, bonds, commodities, and virtually every major financial market. Today, we'll examine why many investors are watching the dollar and the yen so closely, why Japan's economy plays a much larger role in global finance than many people realize, and how rising debt levels around the world may be reshaping currency markets. We'll also explore why exchange rates can become a leading indicator of broader market stress, and whether current conditions deserve investors' attention. Let's begin. Why the dollar and yen matter. To understand why this currency pair attracts so much attention, we first need to understand Japan's unique role in the global financial system. Japan is the world's third largest economy. For decades, it has maintained extremely low interest rates, often far below those in the United States and Europe. Because borrowing costs in Japan have traditionally been so low, investors around the world have used the Japanese yen to finance investments elsewhere. This strategy became known as the carry trade. Here's how it works. An investor borrows money in Japanese yen at a very low interest rate. They then convert those yen into another currency, perhaps US dollars, and invest in assets that offer much higher returns. Those assets might include US Treasury bonds, corporate debt, technology stocks, or emerging market investments. As long as the yen remains relatively weak and interest rate differences remain favorable, the strategy can generate attractive returns. But there's one major risk. If the yen suddenly strengthens, investors must spend more money buying yen to repay their loans. That forces many of them to unwind their positions quickly. And when large numbers of investors all rush to sell assets at the same time, markets can become extremely volatile. This is one reason professional investors closely monitor movements in the dollar-yen exchange rate. It isn't simply about two currencies, it's about global liquidity. The importance of currency stability. Currencies perform a simple but critical function. They allow countries to trade goods and services efficiently. They help determine import prices, export competitiveness, inflation, and investment flows. When exchange rates move gradually, businesses have time to adjust. But rapid currency movements create uncertainty. Import costs can surge. Corporate earnings become less predictable. Inflation can accelerate. Investors begin demanding higher returns to compensate for additional risk. This uncertainty often spreads beyond currency markets. Bond yields may rise. Equity markets may become more volatile. Commodity prices can fluctuate sharply. That's why central banks often monitor currency markets just as closely as inflation data. Why Japan faces a unique challenge. Japan has spent decades trying to stimulate economic growth. After experiencing a prolonged period of weak inflation and slow expansion beginning in the 1990s, policymakers adopted increasingly accommodative monetary policies. Interest rates fell towards zero, then below zero. The Bank of Japan also purchased enormous quantities of government bonds in an effort to keep borrowing costs low. These policies helped stabilize financial conditions, but they also created an important side effect. When other countries, particularly the United States, began raising interest rates aggressively in response to inflation, the gap between Japanese and American interest rates widened dramatically. Investors naturally shifted capital toward higher-yielding U.S. assets. That increased demand for dollars while putting downward pressure on the yen. Over time, the weaker yen made imported goods more expensive for Japanese consumers. Energy costs rose, food prices increased. Inflation, once absent for years, became more noticeable. This placed Japanese policymakers in a difficult position. Raise interest rates too aggressively, and economic growth could slow. Leave rates too low, and the currency could weaken further. Neither option is ideal. When governments step in, most exchange rates are determined by market forces. Buyers and sellers interact continuously, setting prices every second of every trading day. But occasionally, governments decide that market movements have become excessive. When this happens, central banks may intervene. Currency intervention can involve buying or selling enormous amounts of foreign exchange in an attempt to influence exchange rates. The objective isn't necessarily to reverse a long-term trend. Instead, policymakers often seek to reduce extreme volatility or discourage speculative trading. Interventions don't always succeed. Markets are enormous. Daily trading volumes in foreign exchange exceed several $trillion. No central bank can permanently overpower global investors. However, interventions can temporarily stabilize markets and send a powerful message about policymakers' intentions. Whenever speculation grows that authorities might intervene, investors often become more cautious, and that caution can spill over into stocks and bonds. Why investors watch technical levels? Some market participants rely primarily on economic fundamentals. Others study price charts. Technical analysis doesn't attempt to predict the future with certainty. Instead, it identifies areas where investor behavior has historically changed. Certain price levels attract attention because traders remember what happened previously. If prices break above or below those levels, buying or selling activity can accelerate. This doesn't mean markets are following magic lines, it means human psychology often repeats itself. When enough investors are watching the same level, their collective actions can influence short-term price movements. For this reason, experienced traders often combine technical analysis with economic data rather than relying exclusively on either approach. And when technical signals align with changing economic fundamentals, markets tend to pay closer attention. As we wrap up today's discussion, remember this. Financial markets rarely move because of a single headline or one dramatic event. More often, they're shaped by dozens of interconnected forces working beneath the surface. Interest rates, government debt, central bank decisions, investor psychology, and yes, even the movements of currencies that most people never think about. The Japanese yen isn't a crystal ball, and the US dollar isn't guaranteed to keep moving in any one direction. Markets have a way of humbling anyone who believes they've figured everything out. That's why successful investing isn't about making perfect predictions. It's about understanding risk, staying informed, and adapting when the facts change. Whether you're a long-term investor, an active trader, or simply someone trying to make sense of an increasingly complex global economy, one lesson stands out above all. Never ignore the signals hiding in plain sight. The biggest stories often begin quietly, long before they dominate the headlines. If today's analysis gave you a new perspective on how currencies, debt, and global markets are connected, then we've accomplished exactly what this channel is all about, looking beyond the noise and focusing on the bigger picture. Of course, none of this is financial advice. Every investor's situation is different, and every investment carries risk. Always do your own research, consider multiple viewpoints, and make decisions based on your own financial goals and risk tolerance. If you enjoyed this video, take a second to support the channel by hitting the like button. It tells YouTube that this kind of in-depth analysis is worth sharing with more people, and unlike trying to convince the market to cooperate, pressing that button actually works. If you're new here, don't forget to subscribe to Nicholas Gurneman and turn on notifications so you never miss future deep dives into the global economy, financial markets, investing, and the macroeconomic trends shaping our world. We cut through the hype, question the conventional wisdom, and explore the forces that really matter, occasionally with a little sarcasm. Because let's face it, sometimes the markets practically write the jokes themselves. I'd also love to hear your thoughts. Do you think currency markets are signaling bigger challenges ahead, or is the market overreacting to short-term volatility? Share your perspective in the comments below. Some of the best conversations happen there, and your insight might help someone else see the market from a different angle. Thank you for spending your time with me today. Your attention is the most valuable investment you can make, and I truly appreciate that you chose to spend some of it here. Until next time, stay curious, stay disciplined, keep learning, and remember, the goal isn't to predict every market move, it's to understand the forces behind them. I'm Nicholas Gurneman, and I'll see you in the next video.